Fear, confusion, and stress. As a beginner, investing might be very intimidating. All the graphs, confusing names, weird abbreviation, and all the different investment options like stocks, crypto, mutual fund, ETFs, or Forex can make you feel lost. But after studying and reading several books on finance and money and investing for many years, I reveal the top 5 tips I wish someone had told me when I was first starting out. In fact, you don't have to be a Wall Street expert to start investing. You might be surprised at how easy it can be with the right strategy. It's never too early or too late to start investing. Are you ready to stop just talking about investing and start taking action? Then stick around until the end, because the final tip could be the key to unlocking your financial success. Let's get into this. Investing is not just for the rich. You can also start with little money to start building wealth and become rich in the future. The key is to start small and be consistent. Just take a look at some of the most successful investors out there, like Warren Buffett or Peter Lynch. Warren Buffett started investing when he was 11 years old and is known as the most richest investor of our time. And Peter Lynch started during his time at college. He bought stocks for $700, which turned out to have a big upside, and sold them 2 years later when the shares went up to over $7,000, which he used to pay his education. And you can do this too. You can start by investing in low-cost index funds. If you invest $100 a month in something like the S&P for 35 years, you will have $380,000 with a total of $42,000 invested. Sounds like a fair deal, right? Number 2. This is a very important lesson you have to learn. Time in the market beats timing the market. Because if you're trying to time the market, you will lose lots of money. Every investor who has been in the game for a couple of years will tell you exactly the same. You won't be able to outsmart the market. Do not focus on short-term results, because most people cannot predict the market. Trying to do so can result in missed opportunities and unnecessary stress. The market reacts emotional. Rather, focus on the long run and see what a company or the US market in general can do in 10 or 20 years. The longer you stay invested, the smaller the possibility to lose. There actually has been a study on this from Reddit. It is called Timing the Market, the Absolute Worst versus the Absolute Best versus Slow and Steady. It was all a theoretical study in which there were 3 investors, all of them investing for 40 years. The one with the worst timing who bought before every crash. What a poor guy. One with the best timing who bought right after the crash or a dip. And the last one who just bought monthly, whether it's going up or down. And the result blew my mind. All of them invested $96,000 each in the S&P 500 index fund. Investor A, with the worst timing in the world, had $660,000. Investor B, with the best timing in the world, got almost $1 million with $950,000. And our lazy investor, who automated it, ended up with almost $1,400,000. So, don't stress over timing the market and stay consistent. Number 3, as mentioned in the previous tip, short-term gains are not very relevant, so you don't need to monitor your investments daily. Investing is not day trading, a huge misconception. The stock market can be volatile in the short term, and seeing your investments going up and down every day can be stressful. It is actually harmful to your mental health. And let me tell you, the stock market can be a real roller coaster. Instead, try to check your investments once a month or once a quarter. This way you can get a better sense of how your investments are doing over the long term, and FOMO, fear of missing out, cannot affect you. Number 4, investing can seem intimidating, especially if you're not great with numbers. But the truth is, you don't need to be a math genius to invest. Investing requires 4 great math skills. Most of investing is just common sense. Investing over a long period, don't be affected by FOMO. Buy low and sell high. Easy, right? Let me show you an example of a stock graph. If I type in Apple, it'll show me at what price it's being traded right now, which is at $157. It went up by $2 or 1.8% today. Everything above the line means it's traded at $150, and below the line means it's traded at $149 or less. looks pretty crazy, but in reality, it isn't. In fact, many successful investors have made their fortunes by sticking to these basic principles. Before we explain the final and most crucial tip, I would love if you subscribe if you haven't and tell your friends about it, because the bigger this channel gets, the more videos I can shoot for you and teach you even more. On to the final and most important tip. The earlier you start investing, the better. Why? Because of the compound interest. Use it to your advantage. Compound interest is one of the most powerful forces in investing. Compound interest is the idea that your money can earn interest on top of your interest on top of your interest over time. This means the longer you stay invested, the more money you can grow. So, if you're young, start investing now. Your future self will thank you. Here's an example. Person A, let's choose a random name, Dwight. So Dwight earns $50,000 per year and invests 20% of his income, which is gonna be $10,000 per year. He starts with 21, invests for 30 years, and then waits another 9 till he's 60, but he's not touching his investment. Person B, let's call him Jim. Jim earns $100,000 per year and invests as well 20% of his income, so $20,000 per year. But he likes to party in his 20s like most dudes. He starts investing with 30 and gonna invest for 30 years as well, and will stop at 60. Jim is gonna have after 60 $3,600,000. But Dwight will have $4,290,000 after 60s. That's a difference of $650,000. Although Dwight invests just half of the amount of what Jim invested. I hope you found these tips helpful. Remember, investing doesn't have to be complicated or intimidating. With a little bit of knowledge and some common sense, anyone can be a successful investor. Thank you for your time. Watch this video next and use these tips I just gave you.